Wall Street just declared war on itself. And silver is the battlefield. Mark here from GoFinance. Goldman Sachs just told clients to remain cautious on silver. JP Morgan said silver has a $75 to $80 floor and is unlikely to fully relinquish recent gains. Same metal, same crash, same data, completely opposite conclusions. And here's why this matters. These aren't random YouTubers guessing. These are the largest investment banks on the planet. They have armies of analysts, billions of dollars at stake, access to data you and I will never see, and they can't agree. So either one of them is catastrophically wrong. Or, and this is what I actually believe, they're positioning for different outcomes because they know something we don't. And in this video, I'm going to show you exactly what that is. Because the split isn't about fundamentals. It's about who they want holding silver, and more importantly, who they don't. Subscribe to GoFinance if you haven't already. Drop a comment and tell me, do you trust Goldman or JP Morgan on silver? I read every single comment. Now let me show you the exact statements each bank made. Goldman Sachs, February 4th, 2026. Analysts Lena Thomas and Don Striven. We continue to see significant upside risk to our gold forecast of 5,400 per troy ounce by December 2026. Our forecast incorporates two drivers: that central banks maintain their recent pace of accumulation, and that private investors step up gold ETF purchases as the Fed cuts rates. Bullish on gold. Very bullish. 5,400 target. But then they say this about silver. In silver, we continue to advise volatility-averse clients to remain cautious. The persistent London liquidity squeeze adds an additional layer of extreme price behavior on top of the same call structure-driven volatility seen in gold. Translation: stay away from silver. It's too dangerous. Now JP Morgan. Same week, completely different take. Well, even with the recent near-term volatility, we believe longer-term rally momentum will remain intact. We forecast a floor of around $75 to $80 per ounce on silver this year, with the precious metal unlikely to fully relinquish its recent gains. Translation: silver bottomed. The floor is 75. Buy the dip. Bank of America adds another layer. They're bullish on gold, $6,000 target. But they say this: we were somewhat concerned about the speed of recent price gains and the rise in volatility accompanying them. They're nervous. They want gold higher, but they're worried it went too fast. And then UBS chimes in with the industrial demand argument. With more than 50% of demand linked to industrial applications, we believe current prices are likely to result in reduced industrial demand over time as end users seek to optimize silver usage and lower input costs. Translation: high prices destroy demand. Silver will crash because nobody will buy it at $90. So you have four major banks, all looking at the same data, and they're giving you four completely different narratives. Goldman says, avoid silver, buy gold. JP Morgan says, silver has a floor, buy both. BofA says gold to 6,000, but we're nervous about speed. UBS says high prices kill industrial demand. Who's right? Here's what I think. And this is going to sound cynical, but I've been watching these banks for long enough to know how this game works. They're not giving you investment advice, they're managing flow. Goldman doesn't want retail in silver. Why? Because when retail panics, they sell. And selling pressure creates volatility, and volatility makes it harder for Goldman to manage their own positions. So they tell you, stay away, too dangerous, stick with gold. JP Morgan, on the other hand, wants you in silver. Why? Because they're net long. They've been accumulating for months, and they need buyers at 75 to 80 to create a floor under their positions. So they tell you, don't worry, we've got a floor, rally intact. BofA is hedging. They want to be bullish, but they also want to be able to say, we warned you if it crashes again. UBS is playing the industrial demand card to justify bearishness without looking like they're just guessing. This isn't analysis, it's positioning. About 75% of you watching aren't subscribed. If this breakdown is showing you how Wall Street actually works, hit subscribe. Drop a comment and tell us, do you think these banks are giving honest analysis or managing their own books? Now let me show you the data they're all looking at. Here's the data all four banks have access to. And here's why they're reaching opposite conclusions. Central bank gold buying, 64 tons per month in 2026 so far. That's below Goldman's forecast of 80 tons, but it's still historically elevated, and it's seasonal. Central bank buying always slows in summer, it picks up in September. So Goldman looks at that data and says, central banks are still buying. Our 5,400 target holds. JP Morgan looks at the same data and says, central banks are buying. That supports 6,300. Same data, different targets. Because they're making different assumptions about where it goes next. Fed rate cuts. Both banks assume the Fed cuts rates in 2026. Lower rates are a much slower opportunity cost of holding gold, so much higher prices. But they disagree on how much that matters. Goldman thinks it's the second biggest driver after central banks. JP Morgan thinks it's bigger. ETF flows. This is where it gets interesting. Goldman says, private investors will step up gold ETF purchases as the Fed cuts rates. But ETF flows have been soft for years because real yields were high and cash paid 5% risk-free. If the Fed cuts and real yields drop, ETFs could see massive inflows. That's billions of dollars of new buying. Or if investors don't trust the rally, ETFs stay flat and gold stalls. Nobody knows which scenario plays out, so Goldman and JP Morgan are betting on opposite outcomes. Now let's talk about silver specifically, because this is where the divergence gets extreme. Goldman's argument against silver: the persistent London liquidity squeeze adds an additional layer of extreme price behavior. What does that mean? It means there's not enough physical silver in London to meet demand. So when buyers show up, price spikes violently. And when sellers show up, price crashes violently. That creates massive volatility. And Goldman's clients, institutional money, pension funds, sovereign wealth, they hate volatility. So Goldman tells them, stay out, too risky. JP Morgan's argument for silver: silver has a floor of 75 to 80, unlikely to fully relinquish recent gains. What does that mean? It means JP Morgan thinks the crash to 65 was the bottom. Physical demand is strong enough to prevent further downside. And if that's true, buying at 75 to 80 is a gift, because when the next rally comes, silver goes to 100, 120, maybe higher. So JP Morgan tells clients, buy the dip. Now here's the question you should be asking. Why would two banks with access to the same data reach opposite conclusions? 3 possible reasons. Reason 1, they're looking at different time frames. Goldman might be thinking short term, next 3 to 6 months. In short term, volatility is a real risk. JP Morgan might be thinking long term, next 12 to 24 months. And long term, the bull market is intact. Both could be right. Reason 2, they're managing different client bases. Goldman's clients might be more conservative. Pension funds, insurance companies, they can't afford 50% drawdowns. JP Morgan's clients might be more aggressive. Hedge funds, family offices. They're comfortable with volatility if the long-term thesis is strong. So Goldman gives conservative advice. JP Morgan gives aggressive advice. Both are serving their clients. Reason 3, they're positioning their own books. Goldman might be short silver or underweight, and they want to keep prices suppressed while they accumulate. JP Morgan might be long silver, and they want buyers to come in and create a floor under their positions. I don't know which reason is true. Maybe it's all 3. But what I do know is this. When Wall Street splits like this, it's usually not about fundamentals. It's about positioning, flow, managing risk, serving clients, protecting their own books. And the retail investor, you're just caught in the middle trying to figure out who's telling the truth. So let me give you my take, because I don't have a position to manage. I don't have clients to serve. I'm just looking at the data. Here's what the data actually says. Silver crashed 47% in 7 days, from 121 to 65. That's the second worst crash in silver history. Only 1980 was worse. But the fundamentals didn't change. Industrial demand is still strong. Solar, EVs, AI, all need silver. Supply deficit is still real. China export controls are still in place. What changed was sentiment and leverage and forced liquidations. So the question is, do you believe the crash was a fundamental repricing, or was it a technical flush? If you believe it was fundamental, Goldman is right. Stay away. If you believe it was technical, JP Morgan is right. Buy the dip. I lean toward JP Morgan's view, but I'm not certain. And that uncertainty is exactly why I'm not all in either direction. Now, let me show you the one thing all 4 banks agree on. Because buried in the conflicting narratives, there's actually consensus. They all agree gold is going higher. Goldman, 5,400. JP Morgan, 6,300. Bank of America, 6,000. UBS called the sell-off normal volatility within a continuing structural uptrend. Every single major bank thinks gold hits 5,000 minimum by end of 2026. That's consensus. And consensus is usually right on direction, even if the exact number is wrong. So if you take nothing else from this video, take this. The gold bull market is intact. Every bank agrees. The disagreement is on silver, and the disagreement tells you that silver is the wild card. Gold is predictable. Central banks buy, ETFs flow in when rates drop, price goes up. Silver is unpredictable. Industrial demand swings. Speculators pile in and out. Physical tightness creates squeezes. Paper dumps create crashes. Gold is the steady climb. Silver is the roller coaster. And that's exactly why Goldman tells conservative clients to avoid it, and JP Morgan tells aggressive clients to embrace it. They're both right, for their clients. But what about you? What should you do? Here's my framework, and this is based on everything I've learned watching these banks for the last decade. If you're risk averse, If you can't handle 50% swings, if you're investing money you need in the next 2 years, Goldman is right. Stay away from silver. Buy gold. Gold will probably go from 5,000 to 6,000. That's a 20% gain. Steady, predictable. Low volatility. Silver might go from 75 to 150. That's a 100% gain. But it might also go back to 50 first. High volatility, high risk. If you can't stomach that, don't play. But if you're risk tolerant, if you're investing for 5+ years, if you can handle drawdowns, JP Morgan is right. Silver at 75 to 80 is probably a gift. Because the fundamentals are so strong that eventually price has to reflect reality. And when it does, silver doesn't go up 20%. It goes up 200%. That's the trade-off. Lower risk, lower reward with gold. Higher risk, higher reward with silver. Now let me address the UBS argument about industrial demand destruction. They say, high prices will reduce industrial demand over time as end users optimize usage. That sounds logical, but it's wrong. Here's why. Silver is 3 to 5% of the cost of a solar panel. Even at $90, it's still 3 to 5%. Companies aren't going to redesign entire manufacturing processes to save 3%. The engineering cost alone would exceed the silver savings. Same with EVs, same with semiconductors, same with AI data centers. Silver is essential, and it's a tiny portion of total cost. So demand doesn't collapse at high prices. It might slow slightly, but it doesn't collapse. UBS is using Econ 101 logic. High prices reduce demand. That's true for discretionary goods, but silver isn't discretionary. It's essential, and essential goods have inelastic demand. That's why JP Morgan is right and UBS is wrong. Now let's talk about what Goldman got right, because they're not entirely wrong. They're right that London liquidity is tight. They're right that volatility is extreme. They're right that silver is dangerous for conservative investors. Where they're wrong is assuming that volatility is permanent. Volatility is temporary. It's a function of leverage and positioning. When leverage gets flushed, like it just did, volatility calms down. And when volatility calms, institutional money comes back. ETFs start buying. Miners start outperforming. That's the cycle. Volatility spikes. Retail panics. Institutions accumulate. Volatility fades. Price rallies. We just went through the spike and panic phase. Now we're in the accumulation phase. And if you wait for the rally phase to buy, you'll be paying 100, 120, 150. That's why JP Morgan says, buy now. Because now is when smart money accumulates. Drop a comment and tell me, are you more aligned with Goldman's caution or JP Morgan's aggression? I want to know where you stand. Now let me show you the one data point that trumps all the bank forecasts. Here's the data point that matters more than any bank forecast, the physical market. Because banks can say whatever they want. They can upgrade targets, downgrade targets, flip positions every week. But the physical market doesn't lie. And right now, the physical market is screaming shortage. Silver lease rates in London, 6.1% for 1-month contracts. Normal lease rates, 1 to 3%. 6.1 is panic. That means institutions are paying double or triple the normal cost just to borrow silver for 30 days. If supply were loose, lease rates would be collapsing, not spiking. COMEX registered inventory, 103 million ounces and falling. March open interest, 429 million ounces. If just 25% stand for delivery, COMEX doesn't have enough metal. China vaults, drained 73 tons in a single day. At that pace, empty in 11 days. Silver premiums, 14 to 15% over spot in the US, 20% in Shanghai. These are not signs of abundant supply. These are signs of a market on the edge of breaking. And yet Goldman says, stay away. Why? Because they know what's coming. They know the physical shortage is real. They know COMEX might default in March. But they don't want retail front-running them. They want to accumulate at 75 to 80. Then when the squeeze happens, they sell to retail at 120, 150, 200. That's the game. And it's been the game for decades. JP Morgan, on the other hand, is already positioned. They've been accumulating since the crash, so they're telling clients, buy now, floor is 75. Because they need buyers to validate their thesis, and they need buying pressure to push price higher. This isn't conspiracy theory. This is how markets work. Banks position first, then they tell clients what to do, and client flow reinforces their positions. It's legal, it's normal. But it's also why you can't just blindly follow bank recommendations. You have to understand what they're really saying, and more importantly, why they're saying it. Now let me give you the framework I use to cut through the noise. Ignore the price targets, 5,400, 6,000, 6,300. Those are all guesses. Focus on the thesis. What's the core argument? Goldman's thesis. Central banks keep buying. ETFs come back when Fed cuts. Gold goes higher. That thesis is sound. JP Morgan's thesis. Physical demand is strong. Paper crashed. Rally resumes. That thesis is also sound. So both banks are probably right on direction. They're just disagreeing on timing and magnitude. And that's fine, because you don't need to know the exact top or bottom. You just need to know the direction. And both banks agree, direction is up. The split on silver doesn't change that. It just tells you that silver is higher risk, higher reward. If you want safety, buy gold. If you want leverage, buy silver. But don't buy because Goldman or JP Morgan told you to. Buy because you understand the thesis and agree with it. That's the only way to survive volatility. Because when silver drops 20% in a day, and it will, you need conviction to hold. If you bought because some analyst said so, you'll panic and sell at the bottom. If you bought because you understand the fundamentals, you'll add at the bottom. That's the difference between making money and losing money in volatile markets. Now here's the question nobody's asking. What if they're both wrong? What if central banks stop buying? What if ETFs don't come back? What if industrial demand collapses? Then gold doesn't hit 5,000. It stalls at 4,500, maybe drops to 4,000. And silver? Silver could go back to 50 or 40. That's the risk, and it's real. So here's my position. I own physical gold and silver, not because I'm certain they're going higher, but because I think the probability-weighted outcome favors upside. If Goldman and JP Morgan are right, I make money. If they're both wrong, I lose money, but I'm sized appropriately. I'm not all in. I'm not leveraged. I can handle a 50% drawdown without panicking. That's the key. Position size matters more than price targets. If you're overweight, you'll panic when it drops. If you're underweight, you'll FOMO when it rips. Find the middle ground. Own enough that you benefit if you're right, but not so much that you're destroyed if you're wrong. Let me close with the 3 scenarios for how this plays out. Because understanding all possible outcomes is more valuable than pretending you know which one will happen. Scenario 1, Goldman is right, JP Morgan is wrong. In this scenario, silver volatility stays extreme, London liquidity stays tight, industrial demand slows at high prices. Retail investors panic sell on every dip. Institutional money stays away. ETFs see outflows. Silver chops between 60 and 90 for months, never breaks out, never collapses. Just grinds sideways while gold steadily climbs. Gold hits 5,400. Silver stays stuck. If you bought silver at 75, you made nothing. If you bought gold at 5,000, you made 20%. Goldman clients win. JP Morgan clients lose. That's scenario 1. Scenario 2. JP Morgan is right. Goldman is wrong. In this scenario, the crash to 65 was the bottom. Physical demand is so strong that paper can't suppress price anymore. March delivery sees massive demands. COMEX registered drains to 20-30 million ounces. Force majeure declared. Cash settlements forced. Paper market credibility destroyed. Physical decouples. Premiums explode to 30, 40, 50%. Silver goes to 100 by April, 150 by June, 200 by year end. Gold also rallies to 6,000 plus. But silver outperforms 3-1. If you bought silver at 75, you doubled your money. If you bought gold at 5,000, you made 20%. JP Morgan clients win, Goldman clients lose. That's scenario 2. Scenario 3, they're both wrong. In this scenario, something breaks that nobody saw coming. Maybe the Fed doesn't cut. Maybe central banks stop buying. Maybe a global recession hits and industrial demand collapses. Gold drops to 4,000. Silver drops to 50. Everyone loses. Bulls and bears, Goldman clients, and JP Morgan clients. The only winners are the people who stayed in cash. That's scenario 3. Which scenario is most likely? I don't know. Nobody does. But if I had to assign probabilities, I'd say scenario 1, 30% chance. Scenario 2, 50% chance. Scenario 3, 20% chance. So I lean toward JP Morgan's view, but not with certainty, just with probability. And that's why I'm positioned accordingly. I own physical. I'm not over-leveraged. I'm ready to add if it drops. I'm ready to trim if it rips. That's the only rational way to play this. Now, here's what I'm watching over the next 3 weeks. 1. March 1st, notice day. February 27th. Do we see massive delivery demands, or do specs roll forward again? 2. Central bank buying. Does it pick up in February, March like Goldman expects, or does it stay flat? 3. ETF flows. Do institutions start buying SLV and GLD, or do they stay on the sidelines? 4. Bitcoin. Does it hold 70,000, or does it break lower and take silver with it? 5. Physical premiums. Do they stay elevated at 15%, or do they compress? Those 5 data points will tell us which scenario is playing out. Right now, physical tightness supports scenario 2, but volatility and uncertainty support scenario 1. So we're in limbo, and that's frustrating. But it's also reality. The banks don't know either. That's why they're split. Do your own due diligence. Understand the risks. This is not financial advice, but based on everything I've shown you, here's my take. The split between Goldman and JP Morgan isn't about who's right or wrong. It's about managing different clients with different risk tolerances. Both banks are probably right for their respective audiences. The question is, which audience are you? If you're conservative, listen to Goldman. If you're aggressive, listen to JP Morgan. But don't blindly follow either. Understand the thesis, size appropriately, and prepare for all three scenarios. Because the only certainty in this market is uncertainty, and the only way to win is to position for multiple outcomes. Drop your take in the comments. Goldman or JP Morgan? Who do you trust on silver? This is Mark from GoFinance. Wall Street is at war, and your job is to profit from the chaos. Stay sharp.